Hello everyone, welcome back into the channel. If you're new, then welcome. Please make sure that you subscribe and like the video and then share with your friends. Also make sure that you engage with us in the comments if you need any clarity in any of the questions, or if you have specific questions maybe that you'd like us to address. Special shout out to all our members at the back. Yes, you can join membership of this channel and then you can basically get exclusive videos, including NBTs, and there's going to be a lot more content that is coming through for the members. It's only for the price of 149 per month, and you will be a member of the channel and support us in the best way possible. Anyways, let's get straight into the question of today. Next question we're going to be looking at here is 3.4. So it's continuing from the previous video. You can check that out in the description below. Here we're looking at dividends, earnings, and returns of Navarra Ltd. This is still on the November 2023 paper. So what does the question say in 3.4? So it says, explain one financial indicator which indicates that a concerned shareholder should not be satisfied with the dividend policy of the company. And then there's another question that follows after that. Explain whether the shareholders should be satisfied with the earnings and returns of the company. And then you quote two financial indicators. So this is a two-part question. We're going to first deal with the 3 marks part because we basically need to identify that financial indicator, quote it, and then do an explanation. All right. So let's look then at the dividend policy. So we can look at the dividends per share versus earnings per share, or we can look at this just the dividend payout policy. If we have a payout, that is even much better. So let's look at, and we're looking at Navarra Limited because the question said we're focusing on Navarra Limited here. Let's look at the dividend payout rate. This is pretty different numbers. So in the previous year, the directors paid out 34.8%, and in the current year, they've paid out 103.8%, essentially paying over the amount of profit that the business made, which basically indicates that this may trifle the future expansion plans of the business. All right. So the first thing, so then the first part of this question is basically quoting. So we're going to quote this financial indicator. We're going to say the dividend payout rate increased from 34.8% to 103.8%. Okay. Shareholder, so as a shareholder, or let me structure it this way, shareholders should be concerned because the business is not reserving any profits for future expansion plans. So you can structure even differently. You can maybe go for the route of saying, the directors are not prioritizing the future sustainability of the company. And you can even say maybe something to the extent of the business is paying out more dividends than it's making in profits, which means that in the future it will struggle for cash and future funding. So anything basically that is within that line. And sometimes you can even look at, the earnings per share, because in this case, it means that the business has has lower earnings per share than the dividends per share. So you can even quote that, but basically it must be about the future sustainability of the company. Next, we are looking at the next question, still in 3.4. It says here that explain whether the shareholders should be satisfied with the earnings and returns of the company. Code to financial indicators and figures. Okay, so two financial indicators and figures, and then explain. So this is how the 6 marks is distributed. Quoting the two financial indicators, each quote gives you 2 marks. and then explanation gives you another 2 marks. So that makes the 6 marks. So that's how it is tested. So let's look now at these ratios. So we're looking at earnings and the returns of the company. So then that means that you're going to be looking at the earnings per share, and then you're going to also be looking at return on shareholders' equity, and then see if the shareholders should be happy about this. All right, so we're going to start with quoting ratios and then go with the explanation. So firstly, let's look at the earnings per share. So the earnings per share decreased from 115 cents to 80 cents. So we're going to say that earnings per share decreased from, earnings per share decreased, what was the amount? It was from 115 cents to 80 cents. Let me just double confirm that. Yes, 115 to 80 cents. And then the other thing that we want to quote here is the return on shareholders' equity. So the return on shareholders' equity basically went from 11% to 6.4%. So you're going to say return on shareholders' equity also decreased from 11% to 6.4%. Believe it or not, guys, this is already 4 marks that we would have gotten from this question. Okay, and then now on the commenting part, so the question was whether, because your explanation is explain whether shareholders should be satisfied with the earnings and the returns of the company. So then, in this case, based on these, I would say that the shareholders should not be happy. Should not be happy because the business is less profitable than the previous year. And in addition to that, I want to see if I can be able to at this point. Let's look at the interest rate on a fixed deposit. So interest rate on a fixed deposit is what? 9%, and the shareholders are only getting 6.4% on their investment. So then we're going to say that, and in addition, the return on shareholders' equity is less than interest rate on fixed deposit, which is 9%. Okay, cool. So all the 6 marks there, bagged, easy peasy lemon squeezy. All right, cool. Now let's go to 3.5. So 3.5, it says that we're looking at the shareholding of Nathan Crewe at Navarra Ltd. It says identify the effect of the repurchase of Nathan's shares on his percentage shareholding, quote figures and trends. So the effect of the repurchase on his percentage shareholding in the company. Okay, so let's see. And this is specifically at Navarra. So you can see here at Navarra that previous year owned 55.2%. And then because of that repurchase, see that repurchase that happened there? Remember, there was this repurchase of shares. So that repurchase, it looks like it was basically all his shares, because his shares went from 662,000 down by 300,000. So that was all him. And then now he owns 40.2% of the company. So we're going to say then that we're going to say that percentage shareholding of Nathan decreased from 55%, 55.2 to 40.2. 55.2% to 40.2%, which means he is no longer the majority shareholder. So that would be its effect here, that now as a result of this, he's no longer a majority shareholder. So we've identified the effect that he's no longer a majority shareholder, and we've quoted the actual figures that show that information. And then here it says, then explain how the company was able to raise 4.4 million to repurchase of shares, to finance the repurchase of shares and dividends earned by the shareholders. Provide 2 points. So where did this business get the money? Well, we have to look at a few things. So typically when you want to raise some money, these are the two biggest things that you can look at to find. So one, you can look at whether you can look at the loans. So long-term loan, and then you can also look maybe at a size of an overdraft, like if there was a significant difference there. And then you can also look at whether there were any shares that were issued. So if we look here at Navarra Limited, we can see here that uh, number of shares issued at end of the year. Okay, you can see that there was no repurchase. So sorry, there was no new issue of shares. So it couldn't have been raised from there because basically there was 1.2 million shares at the start, and then after that there was the repurchase of 300,000 shares, and therefore at the end of the year you have 900,000 shares in issue. Okay, so in this case then we can see that, well, it wasn't through an issue of shares. The next thing that you're going to be looking at is the loans. So how could we have found this 4.4 million to finance this transaction? Well, let's look at the loan. So the mortgage loan, you can see that there's an additional loan taken, which was, we went from having a loan of 3 million to now having loans worth up to 6.5 million. So there's an additional 3.5 million. And then also, in addition to this, you can see that the business basically dipped because in the previous year it had no bank overdraft, and now it is 3.2 million deep in an overdraft. So let's go to this question again, and we need to provide 2 points and quote figures. So how was this money raised? So point one, the money could be raised from a loan, as loans increased from 3 million to 6 million 500,000, 6,500,000. All right. And then the other thing that you're going to quote is the money could also have been raised from an overdraft, as the business had zero overdraft at the start of the year to now 3,200,000 at the end of the year. All right, cool. So another 4 marks, pretty straightforward. So we basically provided the explanation of how this could have been gotten, and then we've quoted ourselves. All right, so that's where we are. And then still on 3.5, it says here, give 2 reasons why this decision to repurchase shares should be considered irresponsible. So now, if you're going to repurchase the shares, there's many things that we could say about this repurchase of shares. So one of the things that I would firstly look at is the price that the shares were repurchased for. So let's look at the price first to see if it was irresponsible. So these shares were repurchased for 11 Rand 50. Okay, now let's check what these shares are currently trading at. So 11 Rand 50, by the way, is 1,150 cents. Let's look at the market price of these shares, and we look at even the net asset value. So net asset value of these shares, the book value price of the shares, is basically 992 cents. So firstly, we bought back the shares at a higher price than what they're trading at. But also, if we look at these shares are trading for 400 cents. So they're trading in the stock exchange for 4 Rand, and they were bought back from one of the shareholders for 11 Rand 50. So we can start there. So we don't have to give so many reasons, but there are many reasons that we could quote. So we can say that the repurchase price of these shares is much higher. So the repurchase price of these shares, let's quote it. It's 11 Rand 50 is much higher than the market price. Market price of 4 Rand, and also higher than NAV per share, which I would quote it was 992 cents. So I'm going to write it as 9 Rand 92. So just, putting things in the same way. So we could have went for 11,000 for 1,150 cents, but I just want to keep it the same. So if I go with cents, I go with cents. If you go with rands, go with rands. Just make something that's a bit consistent. Okay, so the other thing is that when you're going to repurchase shares or even pay dividends, you need to basically make sure that before paying before repurchasing or paying a dividend, and after that, the business must still be in a good liquidity position and in a good solvency situation. So let's look at the liquidity of this particular company here. So the liquidity of this company, you can see that basically went from 2.5 to 0.9, 1.4 to 1 to 0.2 is to 1. So the liquidity of this company was, it's very much in question. And then let's look also at, do we have a solvency ratio? If it's not there, it's not super necessary. No. So the solvency isn't given, which is fine. So we're just going to go with liquidity. So this repurchase is done at the expense of the company's liquidity position, which is currently, and the business currently has more current liabilities than current assets. All right. So those would be some of the reasons why I would think that this is irresponsible. Some of the other reasons maybe could be um, the funds were misused because the Nathan Crewe could have overpowered the other shareholders, because at the time before the repurchase he was the majority shareholder. So that's another point that you could put there, but this is enough for the marks that we're looking for. All right, cool. And then lastly, we're going to be looking at 3.6 of this paper. And then after that, we go into question 4. So 3.6 says the CFO has significant influence on the success of a company. Explain why you would agree with the statement. Okay, so the CFO is important because the CFO is important because I think I'm leaving a question here. Let me just double check if we got everything in. Okay, no question missed. So the first question, why you would agree with the statement that the CEO is very important? Well, the CFO is in charge of the finances of the company and is responsible for budgeting and allocating company resources efficiently and therefore needs to be a competent a competent a competent person for the company to succeed. All right, cool. Let's move into the next question. So the next question says, explain whether directors should be satisfied or not with the share price of the companies at the end of the year. Quote two financial indicators in each case with the trends. Okay, cool. So we're going to quote these two cases, and then after that, we're going to make our conclusion. Just going to move this question a little bit down here. All right. So we're going to make our conclusion at the end, but then we're going to make some quotations that we need to make. So we're going to quote two financial indicators in each situation. So firstly, let's start with the market price, because it's basically the ratios that you're going to quote when you're talking about the share price of a company is the market price in the JSE, and then you're going to look at the net asset value per share, which is basically the book value of the shares or the intrinsic value. Let's have a look then. So the market price of shares, let's see. So we're going to say, did it improve or did it not improve? So let's see. The market price of these shares, well, it increased from, I'm going to use rands. I'm going to convert into rands. I'm going to say from 11 rand 50 cents to 13 rand 50 cents. Market price of shares increased from 11 rand 50 cents to 13 rand 50 cents. I don't know. I don't need to put cents here. 11.5 to 13.5 per share. Okay, next ratio that I need to quote is the NAV. So the NAV also increased from 11 rand 10 to 12 rand 30. NAV per share increased from, it was 11 rand 20, 11 rand 10 cents, 12 rand 30 cents, from 11 rand point 1 to 12.3. So we can quote that, pretty straightforward. And then after that, let's look at the other company, Navarra Ltd. So here we're going to point out that the market price of shares decreased from, I think it was 1,800 cents. So decreased from 1,800 basically. So 18 rand to 4 rand. So 18 rand to 4 rand, and then also the NAV per share. The NAV per share decreased from what? So the NAV per share decreased from 10.95 to 99.2. So 9.92, sorry. So 10.9 from 10.95 to 19.2. So, okay, cool. So now it says explain whether directors should be satisfied or not with the prices of shares at the end, code two financial indicators in each case. So, okay, cool. We're going to say then to conclude this, the shareholders of Guardian will be pleased with these increases and the fact that their shares are trading at a higher price than than the NAV per share. Okay, and then lastly, the shareholders of Navarra will not be happy. Will not be happy as all the metrics are negative, as quoted above. Okay, cool. This is a lot that you wrote here for 6 marks, but basically this is what we're given in the answer sheet. So we had to make sure that you have to make sure that you give all of that information. Yes, oh yeah, so there's 6 marks for you, and then, oh yeah, there's the last information that we need to look at. So the last question that you're going to be looking at, which is still 3.6, it says here the CEO of Guardian Limited intends to offer the vacant position of CFO to Nathan Crewe. Explain one point of advice to the CEO. Well, in this case, because you got some of the history, you got some of the history from the other company, you would advise maybe against. So, would say I would say advise against this decision because the track record of Nathan Crewe at Navarra shows that he takes decisions beneficial for him at the expense of the company. All right, cool. So that's pretty much it in terms of what we needed to say and how to basically structure these questions and how basically we get all of these marks. So yeah, so please make sure, guys, that you are practicing in this. Check the other memos, and you can check the memo. I didn't write exactly how the memo wrote, but I'm sure you'll find some of the similarities. So you don't have to write exactly how they write, but you have to say something that makes sense. And to be able to make sense of these, it means that you have to understand and do these many, many more times, and then you'll become more good at it. And yeah, that's it then for this video. Please make sure that you do not forget to like, share, subscribe, and comment, and also join our membership to get all the exclusive content there that is going to help you get into university next year. Cheers, guys.